you going broke? Now that's just a nightmare that nobody ever wants to have. The thought of it happening really makes you just want to scream. Everybody wants to know what's happening to their money, and it really doesn't matter what type of jobs you have. As long as you have money, you'll definitely keep close tabs on your finances that move around. Now don't get me started on how the interest rates play a key role in how much money moves around. I mean, money does fluctuate and nobody ever wants to run at a loss whatever business they own or venture they're into. So in this video, we'll explain how interest rates can affect your money and save you from going broke. Being a borrower. If you are a borrower, raising interest rates will usually mean that you will pay more for borrowing money. And conversely, lower interest rates will usually mean you will pay less. How much of an impact it has will also depend on whether your borrowing is tied more to short-term rates or long-term rates. Short-term consumer loans like credit cards and home equity loans are usually short-term loans like a LIBOR or the Treasury bill rate. Long-term loans like student loans and home mortgages are usually based on the 10-year Treasury bond rate. Your interest rate will rise as the rate rises, and of course, if your loan is a floating loan, they will stay the same, but if you have a locked fixed rate, you won't get yourself confused. The fixed rate loan has a rate and a payment amount that is locked in at a time of origin and does not change over the term of the loan. While floating loan rates have a rate that is set at some spread over an index that will reset at the predetermined intervals and therefore could rise or fall along the payment amount. Being a lender. You may not think of yourself as a lender, but if you possess a bank deposit or bond, technically you're already one. And here's how. Depositing money into the bank indirectly means you are lending money to the bank. Your money is used by the bank to run other financial activities you never see or get to hear about. And of course, they wouldn't just use your money without giving you interest. If you have a locked-in fixed interest rate on these investments, the rate you will earn will usually stay the same for the term. But a rising rate environment will give you the chance to reinvest the money at higher rates as your original loans mature. If your investment has a way to go until maturity, unfortunately, the value of the investment will decline as interest rates rise. Being an investor. If you're an investor in other types of securities like equities or real estate, the level of interest rates can also impact the value of your holdings, although the effect is generally more indirect. The value of your homes and other real estate generally benefit from a falling rate environment. This is not only because people afford higher priced homes, but also because real estate investors can make higher returns as they pay less to borrow on the real estate. The stock market is also impacted by the level of rates because equities are just another alternative investment that the market is consistently weighing against other opportunities. Stocks and bonds are alternative investments, so investors are always comparing the yield that they can get on a stock with the yield available on a bond. So when the rates are falling, the dividend yield on stocks tends to look more attractive next to lower yielding bonds. And thus, stock prices will tend to rise as they will become more in demand. When rates rise and higher bond yields are plentiful, stocks will have a harder time competing, and thus prices will fall to compensate for the lower yield. So there's many things in life, with rising or falling interest rates, better, it depends on which side of the coin you are on. Even the Federal Reserve doesn't really have a favor of lower interest rates or higher interest rates overall. They just want to moderate the level of the rates that is steady, predictable, and conducive to a healthy level of growth and inflation in the economy, because ultimately the market values steady growth and hates uncertainty above all else. I'm sure making smarter decisions toward your financial goal won't be such a big deal now that you understand how interest rates affect your money. Thank you so much for tuning into this video. If you haven't already, please go ahead and like the video and subscribe to the channel if you're new. And we'll see you in the next video.